I would like to thank Chairman Paulson, Ranking Member Heinrich, and Vice Chairman Lee, and all of the distinguished members of the committee for inviting me to testify today. I'm honored to be here to talk about my experience supporting safe and affordable access to credit for America's small businesses and entrepreneurs. Small businesses are one of our country's greatest sources of innovation. All of our most successful innovators, from Apple to Amazon, started small. Their meteoric growth was not inhibited by regulation, but could have been without access to capital needed to grow and scale their business. In my testimony today, I wish to discuss 3 important points. First, most small business owners believe some regulation is needed in a modern economy. While no one likes red tape and filling out paperwork, most Americans can appreciate that some regulation is needed to promote fairness and competition. In fact, according to a new poll released today by Small Business Majority, 3 out of 4 small business owners disagree that we should get rid of all regulations on business and think that some regulations are important to protect small businesses from unfair competition. What's more, an overwhelming majority of 82% agree their business can live with some regulation if it is fair, manageable, and reasonable. Second, many small business owners rank access to capital as a bigger concern than regulation. While our capital markets work well for most established, large, and mid-sized businesses, many small, early-stage, rural, minority-owned, and women-owned businesses often struggle to find financing and consistently rank access to capital as a bigger concern than regulation. Even more concerning, a growing number of financing products are being offered to these businesses by financial firms not subject to the same regulation and oversight as banks. According to another Small Business Majority poll, while small business owners felt that online lending opened up new sources of credit, 8 in 10 reported they were in favor of regulating online lenders to ensure that interest rates and fees were clearly disclosed to borrowers. And this brings me to my final point. Smart policy can promote safe and affordable credit and encourage innovation. Transparency is critical to promoting market competition, which should ultimately provide small business borrowers better products at better prices. But to ensure a level playing field among financing providers, disclosure requirements should apply equally to all small business financing products, regardless of whether the provider is a bank, credit card, merchant cash advance, online marketplace lender, payments processor, or any new companies yet to emerge. While transparency would make credit safer and more affordable, there will still be some businesses that will need help qualifying for a loan or accessing critical early-stage capital. I would like to highlight one of the very successful and innovative public-private programs I had the privilege of working on during my time at Treasury as a model for federal support for innovation and entrepreneurship. The State Small Business Credit Initiative was funded with a one-time authorization of $1.5 billion through the Small Business Jobs Act of 2010. It was a new program and a true experiment born of the need to jumpstart small business lending and investment during the financial crisis. The program worked by allowing states to set up their own small business support programs targeted to local economic needs. It was so flexible there were only 2 requirements. States had to establish at least one from a list of 5 possible credit or equity programs, and states had to provide a plan for leveraging $10 of new private sector small business financing for every $1 of SSBCI funds. Unlike other federal programs, it was not a one-size-fits-all approach. Some communities chose to target micro businesses, while others targeted manufacturers or high-tech companies. In total, SSBCI funded 154 state programs, over 80 of them new, and dedicated $1 billion to lending programs and $400 million to venture capital programs supporting early-stage businesses. From 2011 to 2016, the last year data was available, SSBCI supported over $10.7 billion in new lending or investments and was estimated to have created or retained over 240,000 jobs. In total, it supported $2.5 billion in financing for small manufacturers, $1.5 billion for women and minority-owned firms, $4 billion to early-stage businesses with high growth potential. And even more remarkable, with no federal requirement to do so, over 42% of SSBCI loans or investments were made to businesses in low to moderate income communities. SSBCI illustrates the power of leverage, a little bit of federal support partnered with state and private sector resources, and the power of flexibility to drive innovation and inclusive economic growth. We need more smart policy like SSBCI, and I recommend to the committee, if you are considering policies to support innovation in small businesses, you should consider reauthorizing SSBCI in some form. Thank you.